deductions, reduced taxable income, and these are going to be mainly on page 1 of the 1040, right? And they might be on schedule 1, part 2, where we have those adjustments. So sometimes they're called adjustments. Remember, the adjustments are deductions, but they're adjustments before adjusted gross income. And then we have the other deductions, which are itemized deductions or the standard deduction. Adjustments, so standard deduction or itemized deductions. But the key here is that they reduce our taxable income. So we include them before we calculate our tax liability calculation. Whoops, calculation. Versus credits. Credits reduce our tax. So, whereas the deductions are going to result, they're also going to result in a decreased tax liability, but it's only going to be a percentage of that, right? Whatever our marginal tax rate is, that's the amount that that deduction is going to reduce our tax by. Credits will reduce our tax dollar for dollar for based on the amount of tax that we owe. So if we owe $1,000 and we are entitled to a $500 credit, that is going to reduce our tax down to $500, right? So we're gonna, it's gonna be a dollar for dollar. These are generally found on page 2 of the 1040. And we have a multitude of different types of credits. Okay, we have both refundable credits and we have non-refundable credits. And we'll talk about the difference between those. So, if you have the choice between $1,000 deduction or $1,000 credit, you're going to get more bang for your buck with the credit. Because like I said, it's going to reduce that tax directly. So for example, let's just say we've got taxable income, well, no, total income. We'll do 2 scenarios. So income of 100,000, and we have deductions of 10,000. Taxable income 90,000. Let's say our tax rate is 25%. Make it easy. Actually, it's not as easy. So 45,000, what's half of 45,000? 2250. So 2250, 500 is our tax, right? Same scenario, this is with the deduction. This is with credit. 100,000 income, no deductions, taxable income is 100,000. Rate 25%. So our tax is $25,000, but we get a $10,000 credit instead. tax is $15,000. So just an example, a really rough example of the difference there between a deduction and a credit. This chapter, we're gonna go through a bunch of different types of credits that are available to individuals. This is not an exclusive list of credits. There are other types of credits out there, but these are the most common ones that are used by individuals. There are also different types of credits for businesses as well, but we won't go through those. Questions about the general concept and the difference between a deduction and a credit. So that's an important distinction to be able to make. Both of them reduce, yeah, go ahead.
They both are in, when you file income taxes, you use both.
If you're entitled to them, yep. You can use both. Just because you're using deductions, like say the standard deductions, doesn't mean that you're not also entitled to certain credits. So yes, you can take advantage of both if you're entitled to both. You cannot use the same type of tax benefit for both. For example, there's a foreign tax deduction and there's a foreign tax credit. If you pay foreign taxes of $1,000, you don't get the deduction and then also the credit on that same $1,000, right? You can't double dip on that. But yes, there are credits that you can take that, you can take credits and you can take deductions. All right, so let's take a look. Let me get this a little bigger. Oh, look at the golden retriever. I have a golden retriever at home. They're the best. All right. So these are the types of credits that we're going to talk about here. And some of you may be familiar with some of these. If you filed taxes before, you may have claimed some of these credits before. Child independent care credit. This is a credit for individuals who pay expenses toward child independent care, child care, daycare, that sort of thing. Now, each of these credits have specific rules attached to them, and for most of them, there are limits. There are AGI limits, again, that apply to whether or not you can take most of these credits. Okay, so we're going to kind of go back to that as well. There is a credit for the elderly or disabled. Now, a lot of people aren't familiar with this credit. It's kind of a credit that's, well, you'll see when we do the calculation. It doesn't amount to much, and for most people, it doesn't amount to anything. But the authors still put it in here, although in practice, I really didn't see this credit very often. Education credits. These are the credits that most students are interested in and also most familiar with. Foreign tax credit, as I just mentioned. Child tax credit. Now, child tax credit is different from the credit for child independent care expenses. Child tax credit is a credit just for having a qualified child, whether you pay for daycare for them or not. Either way. The first one is just for those daycare type expenses. Retirement savings contribution credit. Certain individuals may be entitled to a credit. Now, this is one of those rare places in the tax code where you actually do get to double dip if you qualify for it. So the retirement savings contribution credit is for, your income has to be below a certain level, and then you can get a percentage of the amount that you contribute to a retirement account back as a credit. And you can also get a deduction for it, which is pretty astounding. Adoption credit. This credit is to help help reimburse for adoption expenses that individuals may incur. Earned income credit. This is the one that causes us the most consternation as far as the calculations in this particular chapter. It's a rather complicated calculation to determine earned income credit. Luckily, there's also a table that can kind of help with determining that. But again, there are income limits for the earned income credit. This, in theory, is a refund of Social Security and Medicare taxes. That's what it's intended to be. It's not a direct refund of it, but that is the philosophy behind it, that for individuals who meet those income criteria, most of the individuals who meet this income criteria pay a lot more in Social Security and Medicare taxes than they do in income taxes, and this particular credit is to help refund some of those taxes that are paid. Now, ironically, you don't actually use the amount of Medicare and Social Security taxes that you pay in the calculation, but it is based on income and the number of dependents that an individual has. And then this premium tax credit, under the Affordable Care Act, if you have health insurance that you get through the healthcare marketplace, the federal healthcare marketplace, and you receive assistance to pay for those premiums, there are two ways that you can receive that assistance. You can receive it as a reduction in your monthly premium, or you can wait until the end of the year and claim the credit on your tax return. Now, the problem with that is that at the end of the year, there's a reconciliation that's done between what the amount of monthly credit should have been and how much you actually received as a credit. So it's possible, and oftentimes happens, that individuals will owe back some of that credit that they received over the year, that prepaid credit, or maybe they'll get additional credit as well. So, but we'll go through all of that when we get to that part of the chapter. Any questions right now before we start getting into this?
I had a question about chapter 8.
About chapter 8?
Yeah, it's a quick question.
Okay.
It says something, when you're renting to family, it's not deductible, but if they sign a lease, does that still count, or? If you're receiving income from them and it's at market rate interest or market rates, then yeah, that could be counted as rental income. But it's got to be at market rates. You can't Discount.
Yeah.
Got you. Okay. Because I was just reading that again, but that's what I was wondering.
Yeah, and I think what they're talking about in the, if I remember right, I'd have to reread it in the chapter. What page are you on? Just, I'll take a quick look at it.
I wasn't.
Oh, okay.
Let me go back to it. I was just looking at it. 8:10. It's the second sentence. If any family uses their rental property, even if they pay the full rental value, the days are considered personal.
Okay, so when you're calculating the expense portion and calculating whether or not it's personal / rental, then yeah, and that would be considered, those would be considered personal days. Again, this is just for a property though that's vacation, where it's part rental, part personal. I think if you're renting it to somebody, to a family member all the time, like it's 100% rental, then there are some different rules. But as far as counting the personal days versus, yeah, and it's supposed to, it's kind of supposed to discourage people from just renting it from a family member just to increase the number of rental days to then get them to the primarily rental portion. So yeah, if that makes sense, or the primary rental, not portion, primarily rental classification. Okay.